If you wanted to know what was the problem with the current system and why it would be so difficult to solve, then you should have come to the IFS residential conference in Oxford in 1997, and you would have heard John Kay explain with his usual admirable clarity precisely what the problems were and why ultimately there was no real solution to them, not within the current framework. And I'll be interested to hear whether what he has to say at the final session reflects any rethinking on his part or reflects much of what he said nearly 20 years ago. That gives me an excuse to plug the fact that the IFS Residential Conference will be held this year in Oxford on the 9th and 10th of September on the subject of corporate tax avoidance. We're next for policy and practice, and if any of you want a leaflet, I have a leaflet here which you can collect from me in the break or after the end of today's session. I've been thinking about these issues certainly since the 1970s. That might be overstating it a bit. I've been interested in these issues. I had a lot to learn before I could really think about them. That's maybe longer than many of you, but it's certainly not as long as some who are here. And indeed, tidying my room recently to get rid of some papers from very large cases I've been doing, I came across a file of papers for a course a session I attended at the University of Michigan in 2005, which was called Corporation Tax for the 21st Century. So I looked through the papers to see whether or not it would actually provide the answers, or what I should say today, but I have to say the papers were some considerable length, and I didn't actually think I had time enough in this session to try and encapsulate what was discussed on that particular occasion. Of course, the proposal that Mike has outlined to you goes back to the 1978 Mead report with the R base, the R and F base, or I think it was the S base, which is the other version of R and F, being the tax on company distributions. And in a sense, I suppose what the group now does is to take that proposal and think about it in the current context, which of course is a great deal more internationally focused than maybe the Mead report was dealing with in 1978. And of course Mead, again, although it didn't go as wide as Murley's in what it looked at in the tax system, was looking at both personal and corporate tax, and that's something that I'm going to come back to in a second. At the time of Mead, I think it's worth thinking about these things in historical. Of course, at the time of Mead, when the cash flow corporation tax was proposed, the United Kingdom was not very far away from a cash flow corporation tax with immediate expensing of most business expenditure. But of course, in the 1980s, we took a different direction. Thinking back again to the 1970s, of course, there was the 1975 European Commission proposal for a system of imputation dividend taxation within the European Union with a basic corporate tax rate of between 50 and 60%. Fast forward a bit through the 1980s and we get to the 1990s and the IFS capital taxes group and the thought that it gave both to taxation of savings and the taxation of capital gains, but also corporation tax, where it seemed where we stood in the UK in the 1990s, early 1990s, all we needed to do was to change one letter in the acronym and we might get close to a better system. In other words, changing ACT to ACE would be something that, again, would be a relatively straightforward and feasible proposal to pursue at that particular time. Again, thinking of developments in the European Union at that time, or European community as it was, the Ruding Committee report with its proposal on corporation tax and the suggestion of 30 to 40% rates of corporation tax. Then, of course, you can fast forward into the 2000s, and, of course, you have the European Commission proposal again for what has eventually become the CCCTB, with the idea of rates of somewhere between 20 to 30%, and the Merley's review. I should say a little bit in defence of the Merley's review. I think Rachel fairly reflected the fact that the Merley's review was an attempt to look at the tax system as a whole and to say that actually the problem with most reform or most discussion about tax reform is that it takes place in too limited a context of just looking at one particular tax rather than the tax system as a whole. But in a sense, if we didn't come out with any particular proposal or radical proposal for the corporate tax, it was possibly because at the heart of it, we didn't actually think there was any sensible proposal you could make for the corporate tax. And that actually one just had to think, well, if we're going to have a corporate tax for the time being, what would be a form which would fit within the broader Merley's proposals, not necessarily thinking that this was something that necessarily had a long-term future. And that actually is the central issue that we have to address as to whether, in fact, the corporate tax does have a future. The corporate tax, as I refer to it then, in its current form, and in the sort of form that the BEPS proposals are trying to maintain the corporate tax in the face of the pressures that are produced by the type of tax that it is and the effects of globalization, all the other financial markets and the like. Of course, when you think about corporate tax, or certainly when you I certainly started to think about corporate tax, what you learnt about it was that it was an element of a tax system which was especially designed to act as some sort of protection to the income tax. Because if you think about essentially a system which doesn't have an income tax system which doesn't have the corporation tax, then what is retained within companies is effectively savings which are then going untaxed. So you need, you sort of think in particular about the corporation tax in the context of an income tax system. And there, of course, you were thinking about it in a domestic sense of some sort of bulwark to a domestic system that wanted to tax income in some sort of way. And as we heard this morning, what has happened is that globalization has effectively detached the corporation tax from the domestic tax system. In other words, we heard this morning about the degree to which companies are actually owned by non-residents, the degree to which shareholders within companies, whether they be domestic shareholders or foreign shareholders, are actually tax-exempt shareholders, not taxed in one way or another. So the central question that it seems to me that we have to ask ourselves when we're thinking about these proposals is, what is the long-term future of the corporate tax? Do we really think that there is a long-term future for what we might call a generalized tax on the profits of companies? And if we do, how can that, if we really think that that is the case, which I rather doubt, what sort of form of tax do we think that should be? There will, of course, be those types of activities or location-specific type activities such as mining, gold mining, or other aspects for which we might decide that actually what we want to do is design a specific charge that will deal with or capture some value from that. And it was noted this morning, I think it was by Ruben, that broadly speaking, if you look at the corporate tax, that it has been possible for countries to maintain a degree of revenues from the tax. But the question is, what is it? Is it some sort of residual value that we see within companies where we think tax systems can capture a certain amount of that value? But to what extent does that actually relate to the tax system as a whole and what we want to achieve through the tax system as a whole? So when I think about the proposal that Mike has outlined sounds fine, but do we actually think that that is what we should be debating? Do we think that actually we should just say, well, forget about the corporate tax, let's reduce it to zero, and let's actually discuss what the personal tax system should look like in the context of a world where actually it's very difficult to relate any tax charge that we can impose on companies to the tax that we're going to impose on individuals, who are the people that we should really be thinking about and what we should really be designing the tax system for. Central to all the proposals that we hear, and I think central to the point that John Kay made nearly 19 years or so ago, is the question as to whether or not you can actually get agreement on matters between different countries. And we know within the European Union they've been discussing the corporate tax for 50 years, if not a bit longer, and they have been unable to agree on a corporate tax system within Europe. Maybe our departure from the European Union will speed up the process when the other 27 members of the European Union can agree on a common form of corporate tax. I'll wait and see with interest on that. But ultimately, maybe we should all just be designing a system that we think works for ourselves rather than worrying too much about these matters of global corporate tax.